Hello everybody, it's me the Boss Hog. We're going to be having a look at how my portfolio has been performing, and as you can see from the title, it could have been better, but it also definitely could have been worse. We're also going to be having a look at two of these companies, seeing how they're doing, and my opinions about them. Let's do it. All right, so first of all, pretty challenging week in all honesty. 30 of my positions were red, some of them quite seriously, although none of them, a dreadful four figure or anything like that. And I did also have, 9 that were green, although only really one of them made a material difference, which you'll see shortly. Again, I continue to slightly outperform the both the FTSE 350, although I'm still behind that over the 2-year run, as well as the SMT 500, who I'm ahead of. So I'm reasonably happy still, despite this. And again, I've been through enough drops in the market now to feel somewhat resilient. I didn't add anything this week, as I've been saying for the last couple of weeks. We're gradually moving our investments toward the back end of the month. That was partly a request from my wife, but also I was very happy to facilitate it because I think the market is going to get worse before it gets better. So we do actually have about 2 weeks worth of investments in cash in our bank account at the moment. But just where my wife and I are experiencing some costs, some slight changes, investment needed for various things, we're now going to be 1 week behind. What should happen is on the 30th of September, there should be quite a large catch up where both me and my wife are paid, and we've already basically paid off some commitments. So that's the current plan there. Just the one dividend this week. So first of all, the asterisk here is because on Friday evening I did technically get the dividend through from Games Workshop, but I'd already done all of this video and I haven't reinvested it yet. So the Games Workshop one is just going to be in next week's when it comes, which is actually also quite a chunky one as well. But all of the numbers here for portfolio value, etc., exclude Games Workshop. I literally only realised I had it when I was reconciling the numbers for this video, and I was like, oh, it came in really late, like 8:40 at night. So I just didn't realise it was even there. So the dividend I did get, or specifically am recording here, is Phoenix Group. So this was expected. It's exactly the right amount. I was expecting it to be a big one. I got 1,000 shares in them. They yield at like 8%, which is fantastic. But actually, I decided here to put this into SMT, who we're going to talk about in a moment. This is a fund called Scottish Mortgage Investment Trust. It's a slightly weird name, but ultimately it's a high growth, high risk ETF, and I did a deep dive on it this week, which I'll share with you because it was quite an interesting and unexpected deep dive that I think is definitely worth going over. And I got some feedback on the fact that it was nice to see sort of a portfolio graph in last week's video. So I have like a whole Google Docs with various graphs. So I thought, well, okay, we'll do another one this week. So and I'll mix these up for the next few weeks until we've gone through all of the graphs and see whether there's any more feedback. So this is my total dividends by month since I started. I did technically start in November the 20th, 2021. And you can see here over time that the dividends have contributed. You can sort of see a bit of a dip between November 21 and April 22. What was happening there was my portfolio used to be a lot heavier on US stocks, about 70% at its highest, which pay more regularly, like they typically quarterly payers. And the reason it was so heavy on US exposure is because I expected the dollar to strengthen and I wanted to take advantage of that. And to be fair, that's exactly what's happened. I wish I'd been even braver and just done 100%, because certainly some of my FX positions at the moment are very favourable. But what then happened is when the UK stocks sort of pay biannually, there's a big catch up. So you can almost like draw a dotted line there on that sort of where it flattens and then goes up. And similar-ish is kind of happening at the moment as well. Like, I'm going to have a really good September, but then it's going to get a little bit quieter towards sort of between November and about March, especially. So slightly different. And you're seeing it basically borne out here now that my portfolio is much closer to 50-50%, which means that, those stocks that are paying a dividend are doing so only twice a year. So I expect this to be a little bit chunky. I do have other graphs that will show different things, but I thought this was something to share. The other nice thing for me is last year I made 2.25k in year one, effectively the calendar year one, and I'm going to beat this by the end of October, just very fractionally. So that will be awesome, and then we'll go from there. So I'm excited about that. And yeah, it's great to see, honestly. The first 3-figure dividend I ever got was when my wife really got excited about dividends. They're an important and reassuring thing for me, especially when the market's red, because effectively companies are paying you to average down, which for me feels actually quite like mentally reassuring, and one of the nice things about a falling market. So that I've really bought into the idea of dividend investing. I do have a lot of growth companies as well that don't pay a dividend, likes of Disney or Genius. But I'm really happy with this graph. To me, it's like, well, great. If I'd have left this in the bank, I would have nowhere near this amount. So it's nice to see. And yeah, this should be growing quite substantially over the current month, and even October's a decent month as well. So that's how my week's doing. Let's have a look at the breakdown of my portfolio performance. All right, so just a few things to call out this week. There's no real reason or bias or deliberate attempt by me to call out just the better performing parts of my portfolio here. It just seemed to be the ones that had a bit of news or have an earnings update. I think the general at the moment, market sentiment's quite negative. So unless you can sort of persuade the market that there's a reason not to be negative, your company is going to be viewed not favorably, and that's really the reason, as far as I can tell, for the fact that I'm more inclined to talk about the stuff that's less red in my portfolio. GENI is here, which is a company I'm increasingly confident in, despite the fact it started life as a SPAC and fell significantly over the last year. Has recovered some ground certainly over the last sort of 3 to 6 months, but I'm sort of surprised this didn't get more news. I think it was, and it even like fell on the day that the news was announced. But GENI have announced a tie-up with Amazon for basically they have something called the Second Spectrum company service that they bought last year. It's now part of their offering, and it's more or less like an augmented reality overlap of gaming. So you can be like watching a player, see performance stats, who you're watching, how they're performing. It's really nifty, and basically the way that Genius is building its proposition in a whole at the moment is basically to give people information, and then to use that information to bet, and then they take a share of that bet, and they've got multiple commercial models in how they deal with the companies behind that. But Amazon is Amazon at the end of the day. It's great that they have that tie-up. They've got a very similar tie-up with Disney effectively for basketball and ESPN. So it's really great to sort of starting to see that, and I think Second Spectrum is really going to allow, it kind of is the missing piece for their proposition, and I really like it. Like I see this all the time when people come to gamble. To me, sometimes I go into a casino, I like it, it's a bit of a vice of mine. But it's amazing to me to watch Baccarat players, which is effectively a coin flip, and it'll be like people are like reading tea leaves or trying to predict what's effectively a coin flip. You have there's no pattern to it, but you'll be amazed at the way that people like study the board, what's going to come, dealer or player, right? And I think by giving people information, you empower them to want to bet more because they think they see things that just aren't there. So it's kind of interesting, as well as obviously for actual sports fans who are interested, in the performance of certain things. I think it's really good as well. It just kind of enhances the whole experience. I think augmented reality in general has been a bit buzzy for many years. Like literally 7 years ago, I got shown augmented reality for how you could use a QR code on a billing invoice, a telecoms invoice, to basically make it come to life and show you things. But it was very gimmicky, like it wasn't really any value add. As far as I could see at the time, it was very simplistic. But over the last sort of 7 years, the technology has just rocketed in terms of its capability. And also, obviously, you've got a lot more adoption now. People are a lot more comfortable with it, etc. So I was really excited about this. I was kind of disappointed almost the stock price didn't go up more. But again, I'm really pleased with Genius, even though I'm still about 35% in the red at the moment. I'm actually going to do a deep dive into Redrow. I went onto their earnings call. I actually thought the results were excellent. I've said multiple times before that UK house builders are a great place to invest at the moment. You can almost pick any of them. I've picked Redrow because I really like their transition, and I really am very confident in my pick here. I think it's the best, basically, that I'm familiar with. I won't pretend like I'm a UK house building expert or anything like that, but I've looked at 6 to 8 different house builders, and Redrow was the one that appealed to me the most. Vistry was actually the other one I did own for some time. But Redrow, I just like the journey that they're going on, and the numbers look great, and it's unbelievably cheap, especially on a forward PE basis. So we'll talk more about that. I was pleased to see the market reward it, but actually, again, in a falling market, it didn't get as much love as I expected it to get. This is mostly just a placeholder. Oh, sorry, before we get to our placeholder, FEVR here did their H1 results. I would describe them as okay. They were kind of reassuring to the market, and indeed myself, who've both lost confidence in FEVR. They've been sort of promising kind of jam tomorrow, costs under control, back to the margins of yesteryear. Haven't really delivered that. Where I'm still positive on FEVR is their revenue and unit sales continue to be really impressive, even in saturated markets like the UK, where they're the clear number one. things were up 6%. In the US, which is the main growth market where the product is extremely premiumly priced, really great results. And to be honest with you, they just need to get their costs under control. Like, this was a business that not that long ago was trading on a 50 PE, and it arguably deserved it because like the margins were just incredible, the growth was incredible, it was a really amazing thing. And now, you know, like the PE here is about 22, which you could say, and I think is still expensive when there's considerable risk of execution for this company. I do think some of the investment banks downgrades are a bit extreme at the moment. I saw one the other day that went from £16 to 7, which I think is really harsh. But yeah, I mean, I must admit, if I didn't have this in my holdings currently, I think I probably wouldn't be buying it for my current risk portfolio. I think you have to have an element of confidence here that the costs are going to come under control. And, you know, historically, the business has done very well by being very capital light. It basically outsourced everything. It was more or less like a brand with a yummy product in. Like FEVR, I think, has got a really strong brand. Whereas now that kind of capital light business is really costing it because ultimately, you know, it's kind of being forced to accept inflation increases. And that's putting huge pressure on what have historically been great margins. So like I said, I continue to think here that they need to bring in like a heavyweight CFO. The original founders are still around and on the board and basically run the business still. And it feels like for the last couple of years that they just haven't been able to achieve scale meaningfully. And now costs are there. And it's just frustrating to see, basically. So I think you have to be reasonably brave to invest in FEVR at the moment. I do think there is still value if you are brave, but you have to be willing to hold this, I think, for 2 to 3 years plus, and have confidence that management is going to get to grips with, you know, everything from freight to glass, especially, is really expensive for FEVR, to staffing even at some of their new locations in America. That's all going to take time to fully come through and sort of repair margins that are heavily under pressure. So my short term here is that I don't believe the business is worth it anymore trading at a premium of 22. I think it should be more like a normal business. Even though it's got that growth potential, I just think there's so much risk here that you need a lot of margin for safety. So, you know, I think here in order to open up a new position, I probably need it to be under about £8. Even though I think the business currently is potentially worth something like 16, 17, which again, if you've seen my FEVR videos, you will notice has been coming down, you know, because I think you just need to update it on the fact the business has changed fundamentally compared to when it was at its peak. So I would describe the results as okay. It was basically good growth, bad costs. Okay, management supposedly have actions in place to address that, but so far I haven't really been seeing it, and margins continue to be under pressure, and I expect them to remain that way for at least another year. This is the placeholder that I've spoke about. ELIX International. So I just wanted to put this on people's radars because I think it's kind of a really nifty little company. They call themselves a challenger consultancy. Think of the likes of, you know, like Bain or, you know, PwC, although obviously that's more accountancy. But yeah, the likes of your management companies. They're basically building one from scratch, which for me is kind of exciting, like professional services company. But I really like their branding, their videos, they're like hiring great, they're buying smartly, and I think like I'm really expecting good earnings here. They trade on a high PE, but you know, kind of 30 PE for a growth company. But this is a really profitable growth company. I mean, they're like returns on investments well into the 30% already. And I just think the business is going to become more and more efficient and lean and capable as it scales, basically. Again, they've made some smart acquisitions. I'll do a full deep dive eventually on this company. I'm kind of trying to work through everyone in my portfolio at the moment. But yeah, I think it's really nifty. It's a very small company still, definitely in the penny stock range. But I think it's worth your attention. And I'm sort of excited about it just because it had a good week. And we'll see where it goes. And last but not least here, this is Scottish Mortgage Investment Trust. For anyone who's not familiar, this doesn't just deal in Scotland. It doesn't even deal with mortgages anymore, but this is sort of a 110-year-old fund that has undergone significant changes. It's run by a company called Baillie Gifford, which is basically an investment house, but it's their marquee brand, basically. And it's extremely large, and again, we're going to do a deep dive in it because my perception of this is actually very different to the reality of it, and I think it's going to surprise a lot of people who even are familiar with SMT. Maybe I'm just maybe I'm wrong there and it was just me that was surprised, but I'm pretty confident people are going to be surprised. So without any further teasing, let's have a look at that now. All right, so a few bits of data to look at here, but I'm going to start with a few comments. So first of all, this is relatively large, especially compared to the ETFs that we've been looking at for the last few weeks. This is a £13 billion market cap company. It has 53 public holdings as well as 44 private ones, and an additional 4 where it has fixed lending agreements that it also displays as well, and a distributed yield of 0.43%. So first of all, here displaying PE is basically meaningless in this fund because of its nature. It has a lot of growth, unprofitable companies, etc. Secondly, for me, I never appreciated that the fund itself was so heavy on private companies. It's actually 28% of its current value, which again to me was a big surprise. I didn't even appreciate that there would be any private companies here. So for me, first of all, actually finding that out was twofold. I think a little bit concerning, just because so many private companies are at a very different stage in their investment than I am, that I'm like happy investing in. Like, if I'm honest with you, I find it very difficult to evaluate non-profitable companies. I get the price to sales and everything else, and what the growth looks like and all the other things that you can talk about, but it's still ultimately a lot of almost arbitrary decisions that are being made to exactly work out what the value is. However, the more I thought about it, the more I kind of liked it, because I realized that I have no exposure to these kind of extremely risky but potentially very large multi-bagger kind of opportunities. And to be fair, as you can kind of see, if I just draw you to the table in the middle at the top, the performance here is all over the place. Those percentages are annualized, and if you look at the 10-year performance here, I mean, it's 20% annualized per year. I mean, that's amazing. Likewise, the 3 and 5 years are also really impressive, but obviously over the last year, and you can also here see it in the graph, this is comparing the fund effectively to the FTSE All World Index. And even though it's still outperforming it over that time, you can see really during this year, it's had a huge drop in that performance relationship. And to be honest with you, yeah, the FTSE All World's got a lot of kind of hedging and companies in from things like commodities that have done just fine. Whereas all the exposure here to that risk, etc., has harmed SMT. Now, what I will say is something else that surprised me here was that my perception of SMT was that it was basically a tech investment. It basically has a lot of exposure to things like NASDAQ, Chinese growth stocks. You can see them there on the left as well, some interesting, more speculative plays, I would say. But my perception of it was that industry allocation would be dominated by technology. That's really not the case. Like, when you look into it, a lot of this is consumer cyclical. Now, there's some arguments to be made here about things like Tesla, NEO, but ultimately those aren't being classed as technology. Even things like Amazon, etc. So I guess there is an element of whether you class something like Amazon as consumer discretionary or tech. And that I think is an okay conversation to have. But the way that they, and indeed Morningstar, report these industry allocations means that actually this is really consumer cyclical heavy. And you can see here the top 3 are pretty dominant, and I guess to some degree communication services as well up there. But then there isn't a huge spread here, and certainly when you compare this to the funds, like, it looks very different compared to benchmarks, right? Like the industry allocation looks nothing like benchmarks at all, not even remotely close. So first of all, like, I just want to summarize that by saying this is a extremely actively managed fund with relatively high management fees. So secondly here, the variance is going to be really extreme. SMT / Bailey Gifford themselves suggest that you want to be holding this for at least 5 years. That's their time horizon. Like, if you're not prepared to hold SMT for 5 years, don't bother. And to be fair, I think the numbers sort of suggest that you could get away with 3 years. But still, I kind of get where they're coming from here. Right? The nature of the investments that they're making should be seen as high risk. There will be some volatility, and you can see, I mean, even the difference between like 6 months, 3 months, 1 month, I mean, it's like all over the place, and the year performance is really rough, right? Minus 40%. So you do have to accept some volatility here. Hopefully, when we review this in another year or two's time, that would be looking better because we would have seen a recovery, but we might not have done, in which case, you're going to be just sinking further and further into the red. So you need to kind of bear that in mind. I would say that the country exposure here, it was a little bit difficult to get an exact, obviously this breakdown was available, so that's the one I've used. There are other breakdowns that itemize the countries, but they were doing things like only showing it for their public holdings, so I could only get like 70% of the fund by country. So instead I had to resort to grouping countries in things like Eurozone and other Europe, etc. It wasn't to me a huge surprise here, the broad overall breakdown. And there are a couple of things that are worth addressing. So first of all, for the Eurozone, this actually quite heavy in the Netherlands. About a third, well, over a third of that 23% is in the Netherlands. And really that's being led by ASML. They also have a relatively large position in Adyen, which is a Dutch payment company. It's literally just outside of the top 20, but it's like 1.5%. And there's a few others as well, but that's being dominated by ASML ultimately, a Dutch semiconductor company that I also have as a single holding in my portfolio. Likewise, Asia emerging here in terms of China, that's responsible for about half of that 20%. Other areas are going to be sort of Korea, Japan, etc. So there's for me at least, that's kind of how you want to look at it. Yeah, Eurozone is basically dominated by Dutch with smaller positions in sort of Germany, France, etc. Asia emerging is definitely dominated by China, but there are some notable differences in that as well. So just to be mindful of that. Everything else I think here is relatively modest, or indeed the United States being half of the fund wasn't a huge surprise to me. Again, this fund, at least how I perceive it, has a high correlation to NASDAQ, right? And again, when you read like UK articles on websites and newspapers, it's all like, oh, SMT had a difficult day because the NASDAQ went down. Like, okay, there's some truth to that, but actually that's not really that's not the reason why. It's kind of way broader, which is effectively, exposure to growth companies, de-risking at the moment, all those kind of other things is what's really driving it. And actually, you could also kind of include China and things like that in this as well when talking about exposure and those kind of things. It's also relatively top heavy as a fund, right? I mean, they only have sort of 53 public holdings, and you can see here like, the 7.1, 6.5, 5.5. So some of these are relatively big. I hadn't even heard of some of these, so that's good from my perspective for diversifying. And I only have a couple in the top 20, although again, ASML and Amazon as well I have, but the rest of them I don't have. Like, I think Nvidia is a really high quality company. I just don't want to be buying at the moment. Things like Mercado Libre as well, basically, South Americans' answer to Amazon mixed with a payment solution, is kind of cool. Also as well, like, I did go into Alibaba in the early days of my investing and decided that I didn't really want to buy individual Chinese stocks. So I don't have any real exposure to China, short of like the general global economy. So actually, again, I'm quite happy to be building here some exposure to China. And again, things like the Netherlands, I'm quite happy to be investing in as well. I don't really want to buy a fund, but places like the Netherlands, Germany, I'm quite happy to have exposure to those kind of places. So fine. I think it was just a surprise when I was researching both sort of things like private company exposure. The volatility here is extreme, I would say. You need to be really comfortable with volatility. This is like the volatility of a single growth share almost. Is pretty crazy. And yeah, so that's the thing. They do actually distribute their yield, their dividend. They pay it out in June and November. So just a small one here. Like I say, it's mainly a growth company, growth ETF, rather than an income one, but that's worth saying. The next thing that's worth saying here is the 0.65% management fee. So this is a bit misleading. The fact that when you look at this on summary level, it's displayed as 0.32%, but that doesn't include several of the costs. And to me, it's much better to think about this as the total. You will find it in the attached documents, but you have to really dive into it. And to be honest with you, when I first, I'd like to actually thank Discord for pointing this out, because originally I'm new to ETF investing, so I was like, oh, it's displayed there on the summary level, and then somebody pointed out to me that actually, you need to open up the documents and it's got something very different. So yeah, they're only basically including 2 of 4 charges in the 0.32%, which apparently is all they have to legally include. But to me, I find it really misleading. Like, I want to know what my management fees are going to cost me. And ultimately it's 0.65%. Now, to be fair, I would say for the fund's performance, especially over the long period, that's totally worth it, right? Like this, again, managing private companies is not so easy. That requires very different knowledge and everything else. So I'm quite happy to pay for it, even though most of my ETFs that I've been trying to get under 0.5% even for managed. So I just wish it was a bit clearer. So I just want to be super clear. 6.5 here, sorry, 0.65 here. Is the management fees total, and to me that's the number that you should be looking at. Now, this to me is also really interesting as well. So this is now my 4th ETF I've done in detail, and again, new to ETF investing, so analyzing them is still a work in progress. But normally with an ETF, it trades super closely to its net asset value. Effectively, it mirrors it. Not with SMT. This is like 10% variance. So right now, the difference between their net assets versus their share price is minus 10% against the share price. So you almost look at this as like an arbitrage gap. That was how I was originally looking at it. And it may well be that the sentiment and everything else means that people are making that difference, but actually here I think what's driving this is the private companies, where net asset value, the worth of those companies is basically calculated during fundraising rounds. And so what I'm expecting here is that people are looking at the portfolio and saying, oh, hang on, 30% of the portfolio is held in these high growth, super risky funding rounds. And therefore, we are calculating as the market that when the next funding rounds come along, those businesses are going to be valued less, and therefore your investments that you've made aren't as good, right? Those assets that you're holding right now are actually worth 9% less. Now, I still think that doesn't explain the whole nearly 10% difference, because in order for that to be the case, right, considering that the funds is 30% private, it would basically mean that about a third of their private investments value has gone, right? That's the only way you can make it add up, right? Private investments come to 30%, the overall fund is down 10%, so it means that basically those private investments have to have gone down on average 1/3. Maybe that is, but that to me just seems really high and probably excessive. Like, I know there has been a lot of bloodshed in the market over the last year, but I would be surprised. I think there is an element of sentiment driven here as well, but again, maybe I'm just not super knowledgeable about those early stage private companies, so there is an element of that as well. I guess here what I'm trying to say is I'm definitely not an expert here. That's how I'm interpreting it. I'm trying to bring you the knowledge of what the situation is within the fund, which, like I say, was new to me in a lot of ways, and that's kind of how I'm looking at it. So I do think that explains a majority of the difference between share price and net asset value, and yeah, that will kind of even itself out over time, and I suspect that it is quite highly volatile over time. In fact, I mean, there's data on Baillie Gifford to suggest it is quite highly volatile over time, but right now it's basically the biggest gap it's been for 5 years, barring June 2022, but it's very close between those two basically, and historically it's been above, which again would make sense if the market's going up and you're expecting your holdings in private companies to also be going up as well between fund rounds, right? So I guess my expectation here, and we can measure this again when we come back in a year's time or so, is that if the market's going well, then you're going to have a plus figure here between share price and NAV, with that expectation that NAV would be marked up, and vice versa if the market's going down. So just something to be mindful of, and think about that exposure to private companies. However, all that said, Morningstar still rates this as of a month ago as a 5-star rating. So it's the second of 2 ETFs we've looked at with a 5-star rating, listed as large growth, which I think is absolutely true in its kind of quadrant of small to large and then income to growth. So yeah, so this isn't even remotely trying to be balanced, and I think that's a fair description basically. So overall, what do I think about SMT? For me, it was a lot of surprises really. When I was doing my research here, I was really surprised. I would also say that Baillie Gifford had one of the least friendly investment pages I've seen. However, when I kind of got my head around the fact that so much of the fund is held in private companies, different reporting standards, different confidentiality in terms of the information available, right? So again, it did start to make sense. And there is a list, although it is in PDF, which is rough, there is a whole list of their holdings that you can download and have a look at, and then literally count the number of companies, by the way, because yeah, they only have detailed reporting on the public holdings within their portfolio, and then I had to go to like Google, Morningstar, a few others to kind of piece this together. So definitely not one of the easiest funds to analyze, but super interesting. And like I say, for me, after I got over the initial shock of like the fact that this is nothing like my perception imagined in terms of industry allocation or private companies, actually I kind of like it. As a long-term investor, I was kind of confident averaging down here, although past performance is of course no guarantee of future performance and all that stuff. I think here, this is a fund that's been going for a very long time, and the last 10 years have certainly been really good, although again, that's probably a little bit flattering because of what the last 10 years broadly looked like from 2008 plus. But yeah, I think here it's good to have exposure, and broadly speaking, this is going to be very complementary for my portfolio. And actually I had been holding back investing in this further because I'm already quite heavy in my technology slice. Tech is about 35% of my portfolio at the moment, but actually now I feel a lot better investing in it. Like, I'm quite bullish about consumer cyclical, consumer discretionary, I'd call them. And yeah, so for me, I'm actually more confident. I'm going to kind of do my best to reassess how I look at this ETF. So yeah, so I'm going to view it more as like, yeah, filling in gaps with my healthcare, where I literally have no holdings at the moment because I sold out of BNY, and consumer cyclical, where I do have some quite large holdings actually, but nothing that they have. So things like Games Workshop and Hollywood Bowl, nothing that they have though. So yeah, so that was my takeaway there. If anyone has any thoughts on that, I'd be interested. But otherwise, let's have a look at Redrow now as well. All right, so just again, as a quick summary for anyone not aware, Redrow is a FTSE 250 listed house builder. And it produced its year-end results this week. They were really positively received by the market. I say really positive. They went up when the market was going down, and to me it still looks cheap. So I obviously take that with a relative confidence from the market. So a few things here. So the top right was their own reporting. You can tell because it's all red, which is their style. So operating profit versus 2021 up massively. Return on capital employed up massively. Net cash up massively. Launched a £100 million buyback, which is about 6% of its market cap. So its first major buyback. It did do in 2019. It did do a sort of Series B buyback, but on their shares, just to sort of simplify its share structure. But I'm kind of putting an asterisk on that. So yeah, about 6% of its market cap. So again, really good to see that confidence. And its dividend was up 31% year on year, again, basically in line with their earnings increase. So for me, really good. The things that they're measuring themselves on is basically, you can see in the table there. But I also think here the bullet points I've just gone through are worth looking at as well. So great. Also, this is interesting to me. They had a sort of capital allocation bit in their earnings deck, which I thought was very clear. And it has three targets. The first one is growth. They still count themselves as basically a growth company, not an income company, which again I think is interesting, especially when you look at the yield. But they have committed to a long-term payout ratio of 33%, so there should now be a very strong correlation between earnings growth and dividend growth. It's going to be basically parallel, but 33%. So growth first of all, then dividend payout, and then buybacks. Those are the priorities for the business, basically. So they're not saying that shareholders won't get rewarded elsewhere. For me, actually, I quite like this. Like, again, as a long-term shareholder, I prefer buybacks from American companies just because I don't get any tax on buybacks, whereas dividends I actually get a 15% tax. For UK holdings, I get 0% tax on both because these are held in my ISA. But yeah, I thought that was interesting in terms of their capital allocation. They kind of clarified and committed to that, so that was great. The other, well, many interesting things here, I guess, just to go through. So I wasn't too surprised by this, actually, although I was surprised by how low the services revenue was. This isn't like a managed company who come in and sort of regularly get that recurring revenue. This is ultimately, they're a house builder. 99% of their revenue is from house building. They don't expect that to change. Effectively, the services are almost like just a little bit on top, basically some upgrades, some work that gets requested on top of, out of the box houses that they're building, and a few other little bits like that. So I guess some people don't like that as much for obvious reasons, because it's difficult forward guidance. That house builder has been around for a while, and it does look at things like order book very closely. So that there is that. I mean, I would say here it has a very chunky order book, right? 1.4 billion is like 3 years worth of sales. So I think it's okay, basically. To me, there's enough forward guidance here. It's not like, they're sitting around waiting for an order to come in. The nature of house builders means that they have very long time horizons. So as long as the order book holds up here, to me, for at least an extra 2 years, I'd be concerned if this fell under actually about 1 billion. Then I might start having concerns. As it is, they've got really a lot of land bank still to go. They're actively building literally thousands of homes at the moment. So great. I'm not concerned, basically, by that. There's a couple of interesting things here. So the average plot price, so literally the cost of the land, which is quite expensive in some parts of the UK, did increase, so 86k per home. But as a percentage of sale price, actually fell from 21% to 20%. And ultimately what that means is, although their input costs are ultimately going up, they're able to pass that through. And to me, that's kind of what I'm seeing across the house building sector, and Redrow is no exception. Not just land is going up, but most of their input costs, labor, materials, etc. is going up. But where the price of homes is going up more, the ratio of how much those costs account for the sales price is actually going down. So even though like Redrow themselves flagged concerns about the competitive landscape of buying land, actually to me it's not particularly a concern because they're passing it through to consumers who apparently are still willing to pay, at least for now. Number of homes built was only up 2%. I actually would say that this was a good result. I would have accepted flat here, honestly. Redrow are going through a bit of a transition at the moment. They historically have been more focused on the south, London. The thing with that is, although the revenue is quite good from those places, I think for obvious reasons, because house prices are more expensive there, it also means the planning permission is slower, costs tend to be higher. But so that's good in terms of like facilitating a increase in the number of homes built. However, to offset that, the homes that they're now building are considerably more expensive, larger, really like forever homes. They're sort of, their average sale price is $500,000 effectively for their homes, which is way above even the UK house price average. So again, here you're looking at kind of marquee homes almost, or homes for people who can afford higher prices. So but I was okay with that transition. Again, there will be some chunkiness in this, but even when you look at the breakdown in their earnings between like where they're building homes, actually in the south as a percentage, it still holds up at like 40% of their homes, which is basically the same as last year. So it's not like they've moved away from the south entirely. It's just the fact of in central, especially even before the north, that's up massively year on year. So that they are gradually transitioning, but they're still obviously going through a lot of land bank in the south. And it's not like they've left the south entirely. It's more of just a strategic nudge moving up north. Here I've got a couple of positives and negatives I want to call out. So positives, basically buyers are cash rich and have resources. 1 in 3 of their purchases are purely in cash, which to me was amazing. I've not seen anything like that before. So and likewise, I mean, it went up massively for them. So the previous year, like 23% of their buyers were pure cash. This year, 33% of their buyers were pure cash. So that jump is massive. This is something that they pointed out as well, basically, that their customers are fairly insulated from cost of living increases. And even where, like they are seeing some cost of living, they're still prepared to invest in a large, beautiful home for a family outside of London, etc. Partly as a result of that, they're largely insulated from government changes. So by this, there's a new homes ombudsman that's coming through. There's cladding implications, although we'll get to that in just a second as well, because Redrow are still impacted by that, but they won't be again in the future. Things like help to buy as well, which is sort of helping a lot of people who have less money, have significantly fallen. Likewise for Redrow, last year again it was more than 20%. This year it was 8%. So and that I expect that to continue to fall, basically because of the what they're building and where they're building. You just won't be able to qualify for some of their homes for that at all, and the people that are buying and need help with help to buy just aren't buying 4-bed mansions, right, or large homes, I suppose. So I expect them to be relatively well insulated. Another thing that they pointed out, which actually I think I completely agree with, is the fact that where in the UK now there's a lot more hybrid working, people are having to go into the office a lot less. So instead of having to go in 5 days a week, you typically are going in 2 days a week now. What that means is that people are willing to live a lot further away from London and indeed other major cities, and therefore are moving out further and being prepared to sort of put down roots more permanently as part of that. And also because they're then working in those homes, they want nicer homes, an extra room for an office, etc., etc. So basically they kind of were accidentally or on purpose, depending on how charitable you want to be, ahead of the curve in terms of hybrid working, where now like the homes they've been building, they're benefiting from the fact that it was less competitive compared to London, but now people really want to live there. This kind of ties in with a desire for a forever home. So because people again are more willing to put down long-term roots if further away, they're willing to invest more in large and more expensive homes, which again I think is cool and interesting and will definitely help Redrow. And lastly, the cost pressures, although they're still definitely there, have been reducing across the board, as they pointed out. So positives there. I would also add another positive to this, which is the fact that like the UK is one of the few developed countries that's expected to see a population increase over this century. When you look at population projections for the likes of Japan or Italy, it just drops massively, right? Not even close. The UK is due to have like a 5 to 10% increase in its population. The UK already isn't building enough homes, and I expect that to just become more of a problem. So again, simple fact of supply and demand. As long as the demand holds up and they continue to pass the pressures through, and they're able to do that, then I expect this to be a really safe investment, especially when you combine it with things like net cash, dividend income, the customers and the homes that they're building, etc. To me is all really positive from that perspective. There are a few negatives here. So first of all, land buying competitive. But again, I feel like I've addressed this with the fact that yes, although there are some increases in land costs, even though they're moving away from London, right? So actually, if they'd have stayed in London, that probably would have been even worse. But they're obviously starting to see some of that increase from people moving further away from London and other major cities. But to me, this isn't a concern because they're able to pass it through. Planning remains difficult. This is a long-term grumble of house builders against the government, which is the national and local governments don't talk very well to each other, and getting planning permission remains incredibly difficult and can be derailed for multiple reasons. They also highlighted market cooling. This was something that was echoed by most house builders. However, like Redrow, along with most of the house builders, were fairly relaxed about this and said, yeah, we have just had a couple of really good years. The market now is coming down to more sustainable levels, and actually we still feel okay about it. And like I saw some data literally on Friday that suggested that house prices have gone up 15% year on year. So again, to me, there's no concern here, even though I keep hearing that house prices, can't keep going up. They still keep going up. So I feel very relaxed about this until I see data that tells me otherwise. I think it's a lot of like scare stories and worries. Cladding work as well, I think is worth pointing out here. So previously, I guess for anyone who doesn't know, there was a big like scandal in the UK and actually a very sad situation where a block of flats burnt down, dozens of people died, and it highlighted the fact that cladding regulations, so like the material that you put on the outside of blocks of flats, were combustible. Which, I mean, sorry, I didn't mean to laugh. It's just astonishing that would ever that wouldn't have been seen as a problem before. An incredible kind of failure from governments to constructions to, I mean, everyone. What was originally going to happen is that house owners themselves were going to have to pay to repair this, right? Which is pretty ridiculous when they did everything right. And so what the government's done is kind of forced house builders that if you want to ever build again and be given permission to acquire land and build homes, you have to contribute to the fund, basically. And fix what you'd done. So originally Redrow had put about 30 million in the provision to repair the work that it has done. It's increased that to 200 million total, so basically another 166 million provision, and that's to also remedy the work of its contractors. So basically third parties. It needs to fix it. Redrow themselves are a bit snarky about this, I would say, pointed out that they were encouraged to build, that the regulation was there, that they feel like they've been put over the barrel a little bit because if anybody doesn't enter into the government scheme, they just won't be able to build homes. Simple as that, right? You just basically get your business destroyed. And and the good thing for Redrow is, again, they're no longer really in the market for building these type of homes. They highlighted almost all of the exposures between 2000 and 2010. But what it does mean is in the current year, basically, because their statutory reporting profit is reduced by the provision, their PE basically goes from 5 to 11. So you do have to consider that. Again, it's not existential to the business in any way, not even remotely challenging. This should be the last provision as I understand it, but it's worth pointing out. So you have to factor in. And lastly, larger cost of living, right? A lot of my confidence in the housing sector assumes that people will continue to be willing to accept cost increases being passed through and will continue to desire Redrow homes. But again, I'm relatively confident on both of those points. I would actually buy a Redrow home if I could afford one. I think they're beautiful and very sort of grand looking English country homes, or at least to me they look beautiful anyway. So yeah, I think that's worth highlighting, that if you can afford them, I think Redrow is one of those things that you would consider buying. So wrapping up here, so the share price projections are all over the place. So analysts are anywhere between 470 and 1060. The share price currently is just over £5. This is a relatively high yielding stock at the moment. It's about 6.5% on its share price. However, its long-term average has been closer to 5%. So I think one of the ways that we can assess this is to ultimately say, okay, what would the share price look like if the dividend average was 5%? And you would get £6.40. So, that's still a significant markup, close to 30% based on current share price. Another thing you could do is look at the UK forward PE average for the construction sector, for house builders specifically within the construction sector, which is a forward PE of 11. So again, you could argue here that maybe the share price is accurately reporting because the current PE is about 11 based on earnings. But again, that if once you factor in forward PE, actually looks really cheap, because assuming that they keep these numbers even static next year, it's going to go to a 5 PE. So for me personally, I have a target of like just over £7 here. So I am really happy sort of buying. I reinvested my dividend into Redrow, even though I did sell actually some shares at about 570, just because where I'd been buying, and then the portfolio position, I just ended up with a larger chunk in Redrow than I wanted. So I guess it was actually quite a timely sell. But yeah, I still like Redrow as an investment. I think the numbers were fantastic. I think they're basically one of the best, better if not the best, investment you can make in UK house builders at the moment. And that was my takeaway from their earnings. I really like them a lot, basically. Anyway, super long video. I feel like I've spoken enough this week. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.